Corporate finance, York Beverages. Initial position. Emphasise the importance of diversified financial strategies, ethical practices, risk management, community engagement, and continuous monitoring. These components form a robust foundation for making informed financial decisions that balance risk, maximise opportunities, and uphold the company's integrity. Enhancements to the initial position. Enhanced diversification, strengthened ethical practices, advanced risk management, deeper community engagement, and continuous innovation. By incorporating these enhancements, York Beverages can further strengthen its financial position, drive sustainable growth, and maintain a competitive edge in the market. WACC. By using the weighted average cost of capital as a crucial benchmark in evaluating their financial options, WACC represents the company's cost of capital, incorporating the weighted costs of equity and debt. Comparing the WACC to potential investment returns, York Beverages can determine if new product projects will generate sufficient returns to justify the investment. For instance, with the WACC trending downward from 6.18% to 3.8%, York might find borrowing more attractive due to lower costs. Additionally, a declining WACC suggests improved investor confidence and potentially lower risk, enabling York to explore expansion or innovation with a higher assurance profitability. Black-Scholes formula. Advantages of considering call price. Accurate valuation. 2, risk assessment. 3, strategic planning. Here's the formula that was used, and for the call price option, which is approximately $11.45. Market considerations against solely relying on call price. We have market volatility. Number 2, complexity assumptions. 3, diversified approach. In summary, the Black-Scholes formula offers valuable insights that should be used in conjunction with other financial metrics and market conditions to make well-rounded decisions. Sensitivity analysis. Risk assessment. By examining how changes in variables such as interest rates, stock prices, and volatility affect the call option price, York Beverages can better understand the potential risks involved. This helps in identifying which factors are most sensitive and could significantly impact the financial strategy. Informed decision-making. Sensitivity analysis allows executives to see the potential variability in outcomes, helping them to make more informed decisions. For instance, if the call price is highly sensitive to volatility, they can prepare for different market conditions and adjust their strategies accordingly. Strategic flexibility provides framework for developing flexible strategies that can adapt to varying market conditions. Understanding the range of possible outcomes enables company to be agile and responsive. Enhanced planning. The analysis aids in better financial planning and resource allocation, ensuring that York Beverages is prepared for both best case and worst case scenarios. Financing options. Short-term financing options. Suppliers may offer trade credit, allowing yogurt beverages to buy now and pay later. 2. Short-term loans. These include loans of credit or working capital loans from banks. 3. Commercial paper. Issuing short-term unsecured promissory notes can provide a cost-effective way to meet short-term liquidity needs. Invoice financing. By selling outstanding invoices to a third party. Long-term financing options. 1. Equity financing. Issuing new shares can raise capital without obligation of repayment. 2. Debt financing. Long-term loans or bonds can provide substantial funds for expansion or major projects. 3. Convertible securities. Issuing convertible bonds or preferred shares combines features of both debt and equity. Retained earnings. Using profits reinvested in the business avoids debt and equity dilution, but many may limit funds available for other uses. Grants and subsidies. Government grants or industry subsidies can provide non-repayable funds for specific projects or research and development. Considerations. Cost of capital. Evaluating the costs of each financing option using metrics like WACC is crucial to ensure that the chosen method is cost-effective. Risk management. Balancing debt and equity to manage financial risk is essential. Flexibility and control. Equity financing may offer more flexibility, but at the cost of ownership stakes. Risks. Short-term financial risks. Liquidity risk. The ability to meet short-term obligations is crucial. Insufficient liquidity can lead to operational disruptions. 2. Interest rate risk. Short-term loans often have variable interest rates. 3. Market risk. Rapid changes in market conditions can impact cash flow and the ability to refinance short-term debt. Credit risk. Dependence on trade credit or short-term loans can be risky if suppliers or lenders change terms or withdraw credit. Long-term financing risks. Leverage risk. High levels of long-term debt increase financial leverage, which can amplify both profits and losses. 2. Interest rate risk. Fixed rate long-term debt protects against rising rates, but may be costly if rates fall. 3. Refinancing risk. The ability to refinance long-term debt on favourable terms can be uncertain, especially if market conditions deteriorate. 4. Equity dilution risk. Issuing new equity can dilute existing shareholders' ownership, potentially reducing control and earnings per share. 5. Regulatory risk. Changes in regulations can affect the cost and availability of long-term financing options. Ethical considerations. Transparency and honesty. Open communication. Clearly communicate the terms, conditions and risks associated with financing options to stakeholders. Accurate reporting. Maintain accurate financial records and disclosures to prevent misleading stakeholders and ensure compliance with regulatory requirements. Fairness and equity. Equitable access. Ensure that financing options are accessible to all qualifying stakeholders without discrimination. Avoid conflicts of interest. Implement policies to manage and disclose any potential conflicts of interest that could bias financial decisions. Accountability, responsibility. Hold executives accountable for the ethical implications of their financing decisions. This includes considering long-term impact on the company and its stakeholders. Due diligence. Perform through due diligence to assess the ethical implications of financing sources and uses, ensuring they align the company's values and sustainability goals. Social responsibility, consider the broader social environmental impact. Ethical investing, prefer financing sources that uphold high ethical standards. Final recommendations: diversified financing, utilise a mix of equity and debt financing to balance risk and maintain flexibility. Ethical practices prioritise transparency, fairness and accountability in all decisions. Risk management, conduct sensitivity analysis to understand potential impacts of market volatility and interest rate changes. Community engagement, incorporate social responsibility into financing decisions, and continuous monitoring, regularly review and adjust financial strategies based on market conditions and company performance to ensure alignment with business goals and stakeholder interests.